Hello, Paul Gerard from Price Accounting Services, back again in this session within our rental property series to talk about the tax issues associated with a change in the use of property. Now, what do I mean by a change of use? I'm talking about a former home becoming a rental property or a rental property becoming a home, vice versa. So changes to the use, really important, and some key tax issues come up from that. Okay, the first issue is that where your property use is partial to producing income, then you're only entitled to a partial deduction as well. What do I mean by that? So let's assume that you're renting out a room in your own home. Therefore, proportionate ownership costs might be capable of being claimed for tax deductions. Certainly not 100%, okay? So again, seek tax advice and get guidance on that. Sometimes too, we need to also consider some expenses which get apportioned by time. So let's use that notion of renting out a room from middle of the year, and you've paid your insurance, let's say 6 months earlier. So you've paid 12 months of insurance, and in the middle of it, you've started a tenant. You can't claim 100% of that. You might need to adjust that expense based on time. So only from when the date of that rental income event occurs. So mathematically apportion some of those costs. Another issue that concerns apportionment of costs can include things like scrapping. Now, scrapping deductions are associated with investment producing properties, okay? So we're not talking about your own home. Scrapping deductions are basically a description for a depreciable asset that ceases its effective life. There's a catch to this, and we've got a more detailed video on this. So scrapping deductions generally arise when an income producing property ceases to be producing income because it's going to be demolished, rebuilt, and then re-rented. That's really important, that re-rented, okay? Now, let's say you've got a 1990 built construction and it still has a remaining $40,000 of depreciable value according to the quantity surveyor report. It's possible, and I'd get tax advice before acting on it, but it's possible that $40,000 could be written off as a deduction in the year that the tenancy ends to allow for the demolition, okay? So that's an issue associated with a change of use. Another change of use issue can be where a former home commences being rented for the first time. There's a special rule in CGT law, and it's section 118-192 of the Income Tax Assessment Act, and it's often overlooked by even experienced accountants who aren't familiar with the property. That's why we always suggest use a property savvy accountant. Section 118-192 is not optional. It says if you've always occupied a property as your main residence, so therefore it's CGT exempt, and it first produces income, then the market value of the property on that date becomes its cost base for CGT purposes, okay? That's really important. That only ever happens once, so it changes the value you would use to calculate CGT. And it could be favourable or very unfavourable depending on what's happened between the time you bought it and the time when you've commenced to rent. So make sure you get that issue right, and again, use an experienced tax advisor for any of the guidance that you need. Another key issue with when property use changes is your insurances. Let the insurer know. Change your insurances to reflect the use. So for example, if you've got building and contents cover for a property that you have occupied, you may not need the same level of contents cover going forward. Now some people say, well, I don't need any cover because I don't have any contents. That's not true. there are certain fixtures and fittings which are contents that remain in the property, such as carpets and so forth. So you don't want to be uninsured for those, because you won't be able to afford to replace them if there's a catastrophic loss of the building. The other key issue is, if in that same situation of your former home becoming rental producing, is landlord insurance. We strongly recommend landlord insurance, because landlord insurance covers tenancy related issues, and it's specific cover. And the policy we generally recommend, and there are others out there, is EBM's rent cover. EBM rent cover is a very specialised policy, and it covers things like rental arrears. It covers tenancy damage. Now, it comes with a word of warning. Arrears, if you read the policy wording, arrears that already exist are uninsured, okay? So you don't want to get in the situation where you've got a tenant who already has arrears and then you take out this insurance, because it's not going to help you. The other key issue with damage created by a tenant, we've probably all seen those horrid videos, usually on a Current Affair or other news programs, where some trashy tenant has just kicked holes and the place just is destroyed. Now, here's the bad news. Many insurers treat that as if it happened over a period of time. It's very important that you're capable of identifying that a specific event occurred. For example, on the 25th of June, the tenant had a party, the son was involved, and all his Facebook friends destroyed the property. That is so important, because otherwise, here's what will happen. The insurer is going to assess your loss and assume that each hole in a wall was done on a different date. One excess for that hole, one excess, and so forth. So you'll end up with very little cover by the time that claim's processed. So traps to discuss with a broker, and again, I recommend EBM for that reason. So make sure insurances are right. And the other thing too, with when change of use of property occurs, is make sure your record keeping is great. We have a tool called My CGT Property Record, and I strongly recommend anytime, maintain it, but anytime a use of that property changes, record it. Record the key date, record what happened. For example, we moved out of the property on the 20th of June, and we're now living in rented property in a different suburb. Why is that important? Well, it might be that A, we've captured the date, or you've captured the date, but it'll tell your tax advisor in 20 years' time where you were living and how you were living during that period of time. So the CGT main residence absence exemption might apply. It's like throwing away receipts otherwise, so don't throw away the information. Just note it down, record it, and roll that record forward indefinitely. Again, using the recommended Dropbox or cloud-based storage, so that you've always got access to these important records. Another important issue around when property use changes concerns loans. Now, I'm going to share with you probably the most common story I hear from people. They move out of their home and then they rent it out, okay? And then they say, I'm going to draw down some of the equity that I've got in that property and I'm going to use it to buy another house that I'm going to live in. And so that loan will be tax deductible. Well, that's absolutely incorrect. And the reason it's incorrect is we always look at borrowed money and look at the use of that borrowing. So in that example, the use of the borrowing might be to buy your new home. So you've just tainted the loan that might have applied to your former home that may well be tax deductible with some non-deductibles. So you blended your loans, real mess. And you could end up, if it's your DIY taxpayer, you could end up making a horrible mess of your tax affairs by overclaiming deductions. And when it's detected, it's very easily detected when your interest deductions in a tax return go from, for example, $10,000 in one year to $14,000 the next year. The tax office, please explain why. They're not going to be forgiving and assume that it was just a genuine mistake. They will assume it's reckless, so there could be penalties and interest, and often it's detected a year or two later, by which time you've already done it again, and it's a horrid mess. So again, when property use changes, great advantage of having a tax advisor. So they're just some of the issues around when property use changes. I hope it helps clear up some misconceptions or provide some further information. Of course, rely on your tax advisor, okay? So that's it for now from me. Look forward to you watching another one of our videos in this rental property series. Check out our playlist, check out all the videos, subscribe. We've got a great subscription feature there, so just click on the logo, or click on the subscribe on our other logo down the bottom right, and we look forward to seeing you in another session. Till then, bye.